Gold front runs a lot of things, grain prices, interest rates. It gives about a 19 to 20 month leading indication of what the movements of oil prices should look like, unless you have an event like the COVID crash putting a thumb on the scale. Gold really pretty much knows what the movements are going to look like in oil prices. You may remember that gold bottomed out in 2018 around 1,200, and then it zoomed up to 2,060 area in August of 2020. So oil prices have yet to echo that. They're just now starting that climb, and they have a lot higher to go. And it makes sense that they should. They're going to have the tailwind of the reopening, people going back to work, filling up their Winnebagos, filling up their boats, driving their cars again. It's going to create more demand, and I don't think that the Biden administration is going to be opening up a whole bunch of new supply. So that would all factor together to make a case for higher oil prices.
Does it also suggest, Tom, that rally in oil prices will be relatively short-lived, given that gold has since pulled back?
No, the gold pullback that we're seeing now will matter 19 to 20 months from now. Oil prices still, they lag by about 19 to 20 months, so we still have many more months to go till we get to the echo point of the August 2020 gold price peak. So there's many more months of rise for oil yet to come, and for grain prices, and for interest rates for that matter.
What about stocks? S&P, what's your call, Tom, after we've seen just a tremendous rally off of the March lows and a bit of volatility here into the new year?
Well, we've done short in our managed account program in February because we saw weakening breadth numbers and excessively bullish sentiment readings. And there's a little bit of a weak seasonality in the latter part of February. So all those added up together to say small decline, not a huge decline, but a tradable one. And we did. I flipped from short to long on Thursday, which was one day early for the S&P 500, but I sure had a good time on Monday with the strong up day. There's a little bit more seasonal softness this week in the first week of March, but then we should see a nice rise for the next week and a week and a half. There's going to be another stumble later in March, but we'll deal with that when it gets closer. But right now, there's more upside to go for the stock market.
So how important, Tom, is what the VIX is doing to that call? I mean, today, for example, it was initially lower, but ticked up by the close. If it doesn't break lower, does that remove some of your bullishness?
Well, the VIX was very important for the flip from short to long last week when I had an expectation of a bottom and was looking around for signs of one, and it just didn't feel quite like we'd gotten all the work done yet to convince everybody that the sky was falling. On Thursday last week, we saw the VIX spike up 35% in one day. Generally speaking, if you get the VIX to go up more than 10% in one day, that's a pretty good sign of a bottom. So a 35% one-day pop is a sign that people are running for the hills. The sky is falling, the world's going to end, we're all going to die, and you can have a whole lot more confidence about jumping in when that's the condition that the market's serving up to you. It isn't always that easy, the market, but every once in a while the market throws you a hanging curveball and you can smack it. And so that was part of what I was seeing last week to make the change back to bullish.
Shepard Smith here. Thanks for watching CNBC on YouTube.